Hi, in this video, I'm going to talk about Index Universal Life, IUL. So this is a very controversy product out there. So it's many people hate it. Some people sell it like crazy. So it's very controversy. So it's kind of relatively new life insurance products out there. So this video, I'm just try to understand it. What is it? Then, the complexity behind it. So just a little information, see if it can help to understand this type of product a little better. So here, Index Universal Life, also called the Equity Index Universal Life, is another form of the fixed permanent life insurance. So they are not variable policy, but they blend the security fixed rate UL with universal life with the growth potential of the market index return. So here they try to tell you this is a type of the life insurance kind of like the universal life, which is not variable universal life, but they kind of use the index side, so give you some like a fixed a little bit rate. Then you also have other accredited growth potentials from the index. So let's see. These policies provide the minimum fixed interest, but also allow the policy owners to use the index option to potentially earn a better return than the guarantee rate. So these policies are tied to the specific market index, usually is S&P 500. Although there are other indexes may be used, there's no direct participation in the underlying index, and not all of the gains from the index are necessarily credited to the cash value. So we talk about this. So basically say, well, this is a type of the universal life insurance. So we have a little, interest rate guaranteed to you. However, you are allowed to participate the potential growth of the index, like S&P 500. So basically, that's the information. So here said the insurance company uses the limitation to moderate their exposure to the significant market increase. An insurance company offering a IUL does not invest in the index directly, but instead invest in the fixed products, buying call option on the index to which the product is tied to. So basically just say, well, they have a creative ways to do that. Say, your money is not invested in the index, but we we use a call option. We use some fixed income, bonds, whatever. Then plus call option. Try to create the return of the index, right? Whatever they try to do. So that's something you just understand that there's your money may not invest in the index funds, right? So they use options to do it. Then there are different methods of the measuring changes in the underlying index. So the percentage change method measures the percentage change in the index from the beginning to the end index interval. Only the index starting and ending point matter. market fluctuation in between are ignored. In those intervals when the index declines, no gain is credited to the account. So basically, they will, you have your own account. So they will like say, how to credit the gains of the index to your account. So first one is the percentage change method. The second one is the point-to-point method. Logs the gain and credit to the account each policy, and the index value at the end of the policy year becomes the starting value for the next policy year. The spread method subtracts the fixed percentages such as 2 and 3% from the index percentage change in the given interval. If the index grows by 30% over the 3-year interval and the insurance company uses 2% spread, an account would be credited 28% increase in the value. Trust me, there's no 28% credit. They will talk about cap. Okay, let's see. So there's called participation rate. Interest cap limited how much the interest is actually credited to the policy. Insurance company can generally change this limit at their discretion. You can see that, right? So participation rate. So let's say assume so IUL uses the S&P index and the gain is 10% over the time period. If the EIUL has a 70% participation rate, then 7% what is credited to the policy. So that's the participation rate. And then the rate cap. So the policy linked to the S&P a rate cap at 10% would limit the benefit of S&P index increase of a. So basically say, there's a participation rate. I hope I am understand this right. So basically say, well, index went up, even index went up 18%. So they have a cap. So you capped at a 10%. Then you have a participation rate gonna reduce it to 7%. That's kind of how something that. So basically, this try to tell you say, well, when the index went up 18% in a year, so you're gonna be capped at 7% to credit to the account. So that's you. The rest is belong to the insurance company. So that's something. This is upside. So that's they usually sell those policies. They will like say, okay, we give you upside, 7-10% when the index go up, more than 7-10%, something like that, right? So they say, okay, how about the downside? When the index go down, say in terms of downside protection, assume the S&P 500 decline 10% over the given index interval. In this case, the account value would remain unchanged from the starting point of the interval. While the policy owner did not earn any interest and have any gain during this period, the cash value did not lose the money due to the market drop. The downside protection can be very appealing to the clients who want to participate in the market again while avoid the loss. These are the complex products with many moving parts and care needs to be taken, so that buyer fully understand how the product works. I don't know many people gonna understand how this works. So basically, when they sell this product, they say downside. Downside say, what, if this year S&P drop 10% or 20%, you gonna there's no drop in your account. You stay zero. So you do not earn anything, but you didn't lose anything. So that's that's one of their selling point about this policy. So say, well, if the index go up 30%, you get 7% in your account. So you don't lose anything, but if there's a gain, you can capture the gain. So that's basically that's how they sell the index universal life insurance. So good or bad, we just have to see, because it's so complex, the product. I don't know the behind the design. Really, they have to testing those products, see if they really make a profit, things like that. Because one thing you should know, those products are very, very expensive. Then I know some advisors, agent, they sell those products, get high commission. So it's, first of all, there's a lot of cost to it. I don't know, it's worth it to buy.